the financial centers of the world. This is Bloomberg Markets with Alix Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, November 10th. Here are the top market stories we are following for you at this hour. Vibe check. The latest read on the U.S. consumer is dropping now with initial UMISH figures for November. We'll break it down with Joanne Su, Director of Surveys of Consumers. Voter check. A new Bloomberg poll shows swing state voters care more about border security than foreign policy, suggesting a difficult balancing act for President Biden, who is preparing to meet with Chinese President Xi next week. And EV check. We'll have more on demand for electric vehicles in the U.S. and the infrastructure that powers them. Brendan Jones, Blink Charging CEO, joins us this hour. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alix Steele is off today. Welcome to Bloomberg Markets. And Guy, happy Friday to you. I guess we're finding out now how happy U.S. consumers are or not feeling.
Well, we've already seen a warning from Richemont. We've seen Diageo warning about consumer confidence. Now we get confirmation in the data. I think consumer confidence may be something of a misnomer here because the consumer certainly taking a turn for the worse in terms of the confidence picture, heading back down. The headline number, Kaylee, 60.4. That is down from the 63.8 and the 63.7 that we were anticipating, the prior number, 63.8. This does not paint a particularly pretty picture. We've been waiting for the consumer to slow down. In fact, consumer confidence, Mike McKee, has been on the floor for quite some time, but we did get a little tick higher. Now it looks like we're getting another tick lower.
Yeah, it's a little hard to explain, but that's why we have Joanne Shu coming on in just a moment to explain what people are thinking. The big news in this report is, for the markets at least, going to be a rise in consumer expectations for inflation. One-year inflation is now forecast to be 4.4%. That's up from 4.2%. And remember, last month we went from 3.2 to 4.2. Now we're going to 4.4, and a drop was expected. 5 to 10-year inflation, 3.2%. That's up from 3%. So all of a sudden, Americans are thinking we're going to be subject to much higher inflation, even though much of what's going on out in the consumer world would suggest the opposite. We're expecting the CPI to fall a little bit for the month of October next week. And gasoline prices, $3.39, have been doing nothing but going down. In terms of the overall headline numbers, you mentioned 60.4 for the sentiment number. Current conditions at 65.7 is down from 70.6, and expectations tumble to 56.9 from 59.3. And I think what is most interesting about this, outside of the inflation expectations, in terms of those large numbers, guys, is that these are big falls. These aren't just a minor drop a little bit. Something has happened to the consumer psyche, at least as measured by the University of Michigan.
All right, Mike McKee, thank you so much for that great breakdown. Let's get more instant analysis now with Joanne Shu, University of Michigan Surveys of Consumers Director. So, Joanne, should we draw a straight line here from inflation expectations being higher, therefore the consumer is feeling worse?
It's actually not quite as simple as that. I think there are a number of factors that are really weighing on consumers. The persistence of inflation is one, of course, and consumers do appear to be worried that inflation is going to pick up again in not just next year, but in the long run as well. But consumers are really being weighed down by high interest rates. I think that, even though, there wasn't a rate hike this month, consumers have been increasingly telling us that buying conditions for cars, for homes, for durable goods, that these buying conditions are really terrible because of high borrowing costs.
Joanne, good morning. It's Guy. So why are inflation expectations rising?
I think even though consumers have seen that over the last year, inflation has slowed down, they're still seeing the stubbornness of high prices, and that's still really hurting their pocketbook and hurting how they feel about their living standards. And given that the slowdown has stalled, the slowdown has decelerated, consumers are concerned that inflation could very well pick up again. We're seeing this also in gas price expectations. You're absolutely right that gas prices have not been trending up recently. But at the same time, consumers are waiting for the other shoe to drop and are expecting gas prices to rise next year.
Well, and Joanne, to your point about a lot of this being just that they're facing higher borrowing costs and that's having an impact overall on sentiment, I can't imagine that language like we've heard from Chairman Powell just this week suggesting like rates may actually go higher if they need to, that isn't necessarily helpful.
I think it's not helpful for consumer sentiment for sure, but it could be helpful in terms of cooling consumer spending going forward. I think consumers are feeling much more apprehensive about the economy than they were just a few months ago. The sentiment numbers we saw today are the continuation of 4 consecutive months of declines, small declines, but still declines in sentiment. I think their long-term economic expectations for the economy are definitely deteriorating. And part of that is because of 2 wars in Gaza, a war in Ukraine, as well as apprehension over next year's election cycle.
Joanne, would you say that inflation expectations for U.S. consumers are now unanchored?
So for long-term inflation expectations, which is what we're usually looking at when we're talking about anchored expectations, it's a little bit above the 2.9 to 3.1 range that we've seen pretty much for the entirety of the last 2 years. However, I think we really want to wait until the end of the month to see if it sticks. I mean, 3.2 is not that, it's just 1/10 above the 3.1, which we've seen multiple times over the last year. So I would suggest caution in looking at this 5 to 10 year number. Let's see if it sticks at the end of the month.
Well, I'm sure the Fed will be watching to see if it sticks, as it really is trying to keep a handle on inflation expectations. But as we know, Joanne, that's just one part of the Fed's dual mandate. Yes, they want to get inflation back down to that 2% target, but they also are trying to look at the employment side of the mandate as well. How much does what's happening in the labor market factor into how consumers are feeling? Are they feeling less confident about their ability to keep their job or get a new one?
Consumers' views of their own personal finances and their own labor market prospects haven't changed a whole lot in this month. That being said, we are seeing some deterioration in consumer expectations over the unemployment rate. People are expecting labor markets to weaken a bit. Income expectations are not nearly as strong as they were in previous months. So it's really not a great sign that consumers see an acceleration in inflation as well as potential weakening in labor markets, which has been our main source of strength in the economy.
Joanne, can you just give me a sense of what is happening within the various income brackets? Are we starting to see the pain being felt by the upper income brackets in a way that we weren't before?
It's actually a little bit different than that. So there was a convergence in sentiment by income over the course of this high inflation period, but they've started to diverge again. Most of the decline in sentiment that we're seeing right now is among younger consumers, lower income consumers. High income consumers, particularly those with large stock holdings, actually their sentiment hasn't moved a whole lot since last month, and that's a reflection of recent strength in the last couple of weeks in stock markets.
So all that's to say, Joanne, that could change very quickly if we get a sudden turn in the equity market.
That's right. I think that the relative strength that we're seeing in higher income consumers is not a very stable situation. Given that they've been moving a lot with stock markets lately, it could take a turn for a worse pretty easily.
Yeah, it's interesting. We're certainly seeing that showing up in Richemont's numbers today, the Cartier manufacturer. Joanne, really great to catch up. Always a pleasure. So useful to do this. Joanne Shu, University of Michigan Surveys of Consumers Director. And this is working so well. Actually, we'd like to expand it as an offering. In a few minutes, Mike McKee is going to be holding a Q&A chat with Joanne for more analysis on the UMich data that we have just seen. You can find that on your Bloomberg terminal. TLIV is the function. Punch it in. This is really useful stuff. It's giving you real insight into what is happening with the U.S. consumer and the U.S. economy. What are we going to be doing next? Well, we're going to go and get an answer to our question of the day. Is this the last call for the consumer? Angie Newman, Managing Director and Portfolio Manager at UBS Private Wealth Management, joining us next to try and discuss that question. This is Bloomberg.
We all want more stability in the treasury market.
Need for a little bit of a stability of yields.
Having 8 to 15 basis points moves every day as something regular is not good.
10 basis point days in the treasury market seem to be, a snooze. It happens all the time.
The treasury market is central to so many other markets.
The yield volatility that we see in fixed income has been driving a lot of what's going on in the rest of the markets.
Going forward, there's a lot of issuance that has to be done.
The distribution of risks have changed.
We have a tug of war that we're going to see playing out between issuance and between a softer economy.
Still really a good chance that we're going to see a lot of this volatility.
The further out you go in the curve, the greater volatility you're going to see.
Volatility is going to be the key throughout most of 24.
There's still a lot of underlying tensions in that bond market.
Those were Bloomberg TV guests earlier weighing in on bond volatility, which, of course, in part has been driven by the economic data. You're certainly seeing a little bit of choppiness in treasuries today after consumer data from the University of Michigan showed they're not feeling so good and inflation expectations are going higher. So that brings us to our question of the day. Is it the last call for the consumer? Let's go now to Angie Newman. She is Managing Director and Portfolio Manager at UBS Private Wealth Management. Angie, thanks so much for joining us on this Friday. If the consumer engine is starting to run out of power, what does that mean for where you want to be in this market?
What it means is that what Chair Powell has been doing in the last 18 months is actually working. We didn't expect that people would be spending more money as interest rates went up and the cost of goods went up. So, yes, the economy is softening here. It is by design. The consumer is weakening. Perhaps the unemployment rate will also, show some signs of weakening as well. But what that means is, instead of 1.5 jobs for every one applicant, maybe we'll be back down to a 1-to-1 ratio. So the economy is softening in a healthy way, in our opinion. This is what a soft landing looks like. And because of that, we actually think interest rates are at or close to the peak. And I know that that sounds a little contradictory based on really recent data, but there's so much recency bias right now in market movements. And we just heard those segments and everyone talking about how volatile the 10-year has been. We actually are calling, our CIO is calling for a 3.5% 10-year treasury by December of 2024.
What does that mean for stocks, Angie? Because in some ways, the lower discount rate that would imply should be good for stocks. But if that lower rate is coming through because the economy is slowing and top line, therefore, at many companies will also slow with it, in theory, that should be negative for stocks. So is a lower yield story coming out of the bond market good or bad news for equities?
Well, it depends on the type of equities. What we're looking at in the equity market are the stocks that really have underperformed in the last year or so. And those are the dividend payers, the dividend growers, the value stocks. For obvious reasons, investors don't want to take risk in the equity market when they can be super safe in the fixed income market or hang out in those 5%, money markets. But when those yields start to come down on the 10-year, and when we can no longer get that kind of yield for cash, that's when we're going to start looking back at these value stocks. So we actually do like those areas of the market, the energies, the consumer staples, the utilities, the industrials. Again, the areas of the market that have lagged and been really sleepy. It's been a difficult conversation with clients because, both getting off the front end of the yield curve and getting out of, a huge, enormous allocation to big tech stocks and starting to broaden out your portfolio has been a very difficult conversation. It's just been too easy, again, to sit in cash and sort of barbell your portfolio to have high risk on one end and lower risk with your cash on the sidelines. But we can't stress enough the amount of reinvestment risk that that poses for the client when yields come down. It's really not a strategy that's meant for durable, sustainable portfolio growth and income.
Well, you're talking to them about yields coming down, you said 3.5%, I believe, on the 10-year by the end of next year. Where are you assuming the Fed is going to be at that point? Because right now the Fed is still saying we're staying higher for longer. Don't expect us to be cutting anytime necessarily soon, and perhaps not that deeply.
Yeah, well, we don't think that's going to be a linear movement. Clearly, it's not like all of a sudden the volatility is going to stop and it's just slowly, surely going to come down to that 3.5% rate. Again, we're very data dependent. We're still waiting on a lot of data. There are many different scenarios that could play out depending on what the Fed says today or what the data of the day is. So not really sure where that puts us, other than in an environment where right now is a really good time to buy bonds. The best time to buy bonds is right before the Fed begins cutting. So while we can't be exact on our timing and our amounts, we can say that it's a really good time to start building a diversified, balanced portfolio in high-quality bonds.
Angie, the other argument against this is that actually the Fed's not going to be determining longer-dated bonds. In fact, the Fed doesn't determine longer-dated bonds in many ways. What's going to determine longer-dated bond yields is going to be government deficits. And government deficits do not look like they are going to be coming down anytime soon. In fact, the danger is they are going to get larger. And as a result of which, the markets are going to require higher and higher yields. What do you say to that, to the people that come back with the argument of saying, I don't want to buy duration because I'm worried about that argument?
It's certainly a potential outcome. It's not our base case, however. Powell said 18 months ago when he began raising rates, it was going to take time for inflation to start coming down. It's not something that happens overnight. We are starting to see that inflation is coming down. We are starting to see progress. We believe that progress will continue. Again, we can't time this perfectly, but this is the first time in a long time, and I've been in this business a long time, where I can actually say that both stocks and bonds as asset classes pose opportunities for really meaningful real rates of return, and well worth the risk of getting in these markets. It hasn't been the case in a long time, but again, we knew it was going to take this long. It's now been 19 months, I think, since he began hiking. We're getting there. We're getting there. It's not going to be linear, but it's going to get there.
Angie, great to catch up. Really appreciate it. Thank you very much indeed. Got to see what's going to happen here. I think this story, it's got a few twists and turns that it left. Angie Newman of UBS Private Wealth Management, thank you very much indeed. I just want to correct something. We were talking about the UMISH data just a moment ago. We said that there's going to be this follow-up Q&A session. It's going to be on TLIV. It's not. It's on LiveGo. Thanks for those that have written in to tell me about that. Useful to make sure we're pointing you in the right direction. Still ahead, SoftBank shares taking a hard plunge. This is the Vision Fund. Losses continue to mount up, and that WeWork collapse hits Mayoshi-san's numbers pretty hard, to be honest. Details in the startup next. This is Bloomberg.
It's 7:20 on the West Coast. So let's get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now from New York is Bloomberg technology co-host Ed Ledlow. So we're looking at New York, we're looking at Silicon Valley, and we looked at what happened at overnight in Asia. We got SoftBank results. Pretty much no good, very bad. And I'm wondering how much we should just blame WeWork for that.
A lot. I mean, it's all deeply connected, right? It's another loss for SoftBank's Vision Fund, $1.7 billion through the end of the September quarter. What's crazy, though, is I know that the shares fell the most in a year, I think November 2022 in Japan. But if you just take a step back, Vision Fund has lost $53 billion over 2 years. And, you talked about the impact of WeWork. Well, the impact of WeWork is $14.2 billion of losses cumulatively through September. And what was so astonishing about the press conference or the analyst call is SoftBank talking about, despite those losses, it still says it's in investment mode and looking to continue to find new startup opportunities.
Ed, is there anything sort of systemic about SoftBank and the risks it could pose into the rest of the financial system? These are substantial losses. And I'm just kind of wondering what the ripple effect of something like this is.
Well, the ripple effect is that the write-down that SoftBank takes on the value of the private companies it holds in its portfolio will have an impact on the valuation for others that are on the cap table. You know, and if you think about the names, I mean, we're focused on WeWork because it's in the news flow this week with the bankruptcy, but it has a lot of other names that are in there. And you also remember that the fund also holds publicly traded stocks as well. So yes, there is a ripple effect. But I think for others, it's kind of like if they're in investment mode, based on track record, do you want SoftBank to come and write you a check if you're a high-flying startup right now? Bit harsh, but I mean, that's where my head goes.
Yeah, very good point. You could see how someone would maybe say, I'll look somewhere else for funding.
Right.
Okay, so Ed, that's kind of one of the bad news stories in the tech space this morning, but there are some good news stories out there as well, including from TSMC, Taiwan Semi. We're actually starting to see maybe the signs of a real recovery in the chip space. How much should we read into what they're seeing in sales into a broader narrative about what's going on in sales?
I think everyone's kind of cautiously optimistic. So the news is that TSMC had a monthly year-on-year sales gain in October, the first time since February. And, you know, TSMC is as close to a crystal ball as you're going to get for lots of highly cyclical end markets like smartphone, like personal computer, because simply put, if they have a year-on-year sales gain, it's an indication that it's a contract manufacturer, right? So the chip makers whose chips go into smartphones are ordering again. They're working through the backlog. The problem we still have is that I come on this show every day on the startup, and it's so inconsistent. You know, Qualcomm signaled that the smartphone market is recovering now and that the picture's a bit more rosy. Then you had ARM earnings yesterday, and when we looked at its royalties revenue, and it makes basically a royalty per chip design that goes into a smartphone, we started questioning that. So it's been inconsistent, but of all of those, TSMC are kind of the tea leaves that you want to be reading.
Ed, great stuff. Thank you very much indeed. Ed Ludlow joining us there. TSMC, I think, is fascinating. As Ed says, something of a crystal ball into what is happening with the chip sector. Ed, Caroline, they've got a great show lined up. They're going to be up in around 90 minutes' time with Bloomberg Technology. What are we going to be doing on this show? Energizing America's EV infrastructure. We're going to talk to Brendan Jones. He is Blink Charging president and CEO about the challenges his company is facing. This as it builds out the EV charging network that is necessary for the transition. But what's happening with that transition? We're going to find out next. This is Bloomberg.
We're about an hour into the U.S. trading session, the last one of the week. Bloomberg's Abigail Doolittle is tracking the moves for us. Abigail.
Well, Kelly, it's been a little bit of a wild day though of small moves on low volume, about 20% below the 20-day moving average. So these are the S&P 500 E-mini futures overnight not doing all that much. Into the open and around the time of the open up about 0.5%, but on those hotter than expected looking forward inflation numbers, you can see the S&P 500 coming in a little bit, up just about 0.2%. This is important because on the week, it could determine whether or not the S&P 500 puts up a gain. Right now, heading to a very small gain, possibly a second gain in 2 weeks. And the top sectors for the index, maybe the only two higher sectors at this point, technology up for a second week, up about 8% over the last 2 weeks. And then communication services, one of those other mega cap tech sectors, higher as well, but not so much. The rest of the sectors are lower. These are the worst two, energy and materials, and energy, of course, in sympathy as we do have crude oil back below $80 per barrel. Now, this is an interesting split and one that could provide some clues about next week. And actually, well, the S&P 500 is now down on the week ever so slightly. But take a look at the solid loss for the S&P 500 equal weighted. So really stripping that mega cap tech sector, those magnificent seven, of their big weighting power. It is down 1.8%, the worst week since late October. And then the Russell 2000 down 4.2%, the worst week since March of this year. Let's check in on a chart that we've been looking at over the last few weeks. It may give clues as to what's next for the S&P 500. So up top is the S&P 500, on bottom the Russell 2000. We're looking at both of these indexes in relation to their 200-day moving average. Those are the long-term buyers who really like these indexes. Well, you can see the Russell 2000, those long-term buyers don't like small cap, and we're back into the range, this descending line of lower highs, telling you that the buyers, each time they've tried to buy the dip, they've had less and less confidence. The sellers stronger and stronger. Well, Kelly, take a look at the S&P 500. It appears that we are going to, we are still within the range. We're not quite down in it like the way the Russell 2000 is, but the Russell 2000, Kelly, those small caps may suggest that next week, and we do have, of course, CPI and PPI at the end of the month, PCE, inflation is still something that investors are certainly taking a look at. And the Russell 2000, I think a lot of this weakness has to do with the banks.
Yeah, absolutely, Abigail. This market is just braced for that data, the CPI data come Tuesday. Abigail Doolittle, thank you so much. Now, let's turn from the markets to what's going on in the political universe, because President Joe Biden will meet with Chinese Premier Xi Jinping on the sidelines of the APEC conference in San Francisco next week. It'll be the first time the pair have spoken in more than a year. And it comes as a new Bloomberg Morning Consult poll shows the former President Trump, leading President Biden on who voters trust to handle foreign policy issues. Just 1% of respondents said U.S.-China relations were their most important election issue. Bloomberg's Anne-Marie Hordern is joining us now here in Washington with the details. So, Anne-Marie, to some extent, I would imagine that polling data like this casts a bit of a shadow on Biden's planned meeting with Xi next week, which is going to be a very big deal for this president who has tried so hard to normalize U.S.-China relations.
Right, and the whole world wants to see a dialogue between Washington and Beijing, especially when you have two massive conflicts in the world, and China and the United States are on opposite ends of both of them. And for China, that's dealing with a struggling economy, they want to make sure they can try to get trade relations back. But to your point, when you ask voters in these swing states, which neither of these individuals are going to win if they don't get these swing states, this is where elections are won and lost. Israel, 3% respondents say there's the number one issue. Ukraine, 3% respondents say it's the number one issue. China, 1%. So this administration is using a lot of political capital, a lot of the president's time on issues that aren't ranking top of voters' mind. And it continues to be the economy. 41% of respondents say the economy matters. And of course, we talk about this all the time. Yep. Even though the administration likes to talk about Bidenomics, they like to talk about the good data, especially in the unemployment market. It comes down to inflation and how American families are just spending more on groceries, on gasoline. Mark Zandi says more than $700 a month. American families that are on medium income are spending because of inflation.
Anne-Marie, can the president make this meeting about domestic issues? I look at what he's going to be talking about with Xi, fentanyl, issues like that are on the agenda. Can he make this about domestic politics?
Well, he certainly will. And a lot of the times we've seen from this administration when they're going out and touting one of their big legislative wins, which was the Chips and Science Act, they talk about bringing that semiconductor manufacturing back to the United States. They talk about the fact that they don't want to be reliant on China. So they will do what they can to make sure that they are making this as much as they can a domestic issue. And it's a great point you bring up fentanyl, Guy, because this is something that we hear a lot of Republicans talk about, not just in Congress. It was a big moment on the Republican presidential debate in Miami. Of course, that was barring the frontrunner, Donald Trump. But the point from our poll shows that the southern border is the most important issue for voters. And that's where the fentanyl is coming in. 68% to 20%. It's the biggest we've seen in terms of where they want to see more U.S. funding go. Less so to Israel, less so to Ukraine, more to the U.S. southern border.
Yeah. Anne-Marie, you mentioned how the frontrunner, former President Trump, the presumptive Republican nominee, was not on the debate stage earlier this week. All time means nothing to me anymore. But this is what we're assuming. It's Trump versus Biden in 2024. How much could Joe Manchin potentially throw a wrench into that with his announcement he's not rerunning for the Senate?
Well, Joe Manchin, yesterday we heard from Jill Stein. I come back to Michigan in 2016. Hillary Clinton lost Michigan by 10,704 votes. Guy, America's a big country, Michigan's a big state. That is not a lot.
It's a very small margin.
Jill Stein took more than 52,000 votes. Having someone who can steal anything from the president is going to be huge. And in our poll, RFK is taking 10%, and he's pulling from both Trump and Biden. But there's other names in that mix as well. So 19% of swing state voters are looking for someone else. They're what we're calling in our poll, quote, double haters. They don't want Trump and they don't want Biden.
Yeah, this is the election that nobody wants. These are the candidates that maybe nobody wants. But it's going to be interesting to see whether they're the candidates we ultimately end up with. Anne-Marie, thank you. I think this polling is absolutely sensational. Bloomberg's Anne-Marie Hordern in terms of the data. Bring us the data that we're watching. It's still a year away, but it's really hotting up. This is Bloomberg.
This is Bloomberg Markets. You're looking live at the principal room. Coming up, Sonal Desai, Franklin Templeton, CIO of Fixed Income, joins Bloomberg Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. It's time for ETF Friday, and today we're discussing a big push by U.S. regulators to speed up settlement times for securities trades. It could cause a headache for $1 trillion worth of ETFs. Bloomberg's Emily Grafeo has the details for us. So, Emily, what's concerning about this to those in the ETF industry?
Well, so we're moving to a T+1 settlement, which means that equities in the U.S. are going to settle in just a one-day schedule. But what's concerning is for a lot of ETFs, one of the things that makes them so great is that they're listed in the U.S., so they trade U.S. hours, but a lot of the underlying holdings can be listed in other countries, so might trade Asia hours or European hours. The problem is that not all the other countries around the globe are going to be transitioning to T+1 when the U.S. does. So there's going to be, at least according to the sources that I spoke to, a little bit of a settlement mismatch for trading when you have an ETF that settles in one day, but the underlying holdings could settle 2 or 3 days. It's not really clear exactly where the costs are going to come in, whether it's going to raise costs for market makers or for the end investors. But I've been talking to a lot of people in the industry, and they're really working through these kinks of what this is actually going to mean for people.
Yeah, but it's going to, Emily, presumably it is going to affect costs somewhere.
Yes.
And ultimately, normally when costs go up, the end consumer usually has to take the hit unless big financial firms are prepared to take it on their margin. Unlikely. ETFs are meant to be cheap. They're meant to be a low-cost entry point into markets for a lot of people, easy entry point. Is that about to change?
Well, yeah, you make a lot of good points, Guy. We have to see. The thing is, a lot of people will say, well, we've already transitioned from T+3 to T+2. The industry figured it out. But I actually spoke to Reggie Brown. He is one of the ETF industry's largest market makers. And he said, I think the bid-ask spread is going to go up potentially. Borrowing costs might go up. And so it's hard to make the connection between, the cost going up for the market maker and that trickling down to the end investor. But a lot of people I spoke to were kind of suspecting that actually could happen. We could see the ETF investor shoulder the costs. Others are saying when this change comes in May, the ETF investor is not going to realize it, but the market makers, the liquidity providers could be working longer hours, could have to do more employee training, or they might have to shoulder some more costs if it comes to like borrowing cash for another day or posting some sort of collateral for another day because of that settlement mismatch.
The consumer usually ends up paying at some point. Emily, this is a fascinating story. I've got to watch this one really carefully. Thank you very much indeed, Emily Grafeo. Let's turn attention to what is happening with the energy transition. EV adoption in the United States very much lags behind those we are seeing in other developed markets. That's thanks in part due to some of the infrastructure challenges and maybe also the size of the country. Let's talk to one of the CEOs who's standing front and center in these conversations. Brendan Jones is the president and CEO of the EV charging company Blink Charging. He joins us now. Nice to see you. Thanks for taking the time to join us.
Absolutely.
You basically come through, you boosted your guidance, so it's great to talk to you on a day when we're seeing the stock up by as much as it is. The stock, though, is down. You started the year at kind of 15. That's the high on the year. You're now trading at 3. You're getting a big pop today. Is this, Brendan, the company turning a corner? Is that what we're witnessing in terms of your numbers?
Yes. It goes back to where we're at in the industry today. Once the frothy valuations subsided significantly for the whole industry, not just Blink Charging, now it's back to fundamentals where revenue and growth was the driver. Now it's revenue plus cost control and profitability are the drivers today. So you've got to have good margin product. You've got to control your expenses, and you've got to march towards EBITDA positive, which we've already set a target out for the end of 2024 to get there. This month and this quarter is a leading indicator that we're going to hit those goals and objectives, and we still have a lot more work to go, but we have a strategic plan to get us there.
Well, Brendan, it's Kaylee in Washington. You are not the only one who has goals and plans. Where I am in D.C., there's a lot of goals that have been set by this administration, including the composition of U.S. cars that are actually going to be electric vehicles in the not-so-distant future. And I'm wondering, from your vantage point, looking at the charging infrastructure, how much capacity there really even is to charge these vehicles, whether you think some of these goals are realistic or going to be very hard to reach.
Yeah, we think they're very realistic to reach. And if we look at what needs to happen, we have to break it down into the different categories of charging. According to Bloomberg's own research, others to validate that, PricewaterhouseCoopers, Waterhouse, and McKinsey, 90% of the charging is going to take place on L2 charging. So that's not the expensive DC fast charging that we see. L2 charging is easy to accelerate. The installations are much easier. It's easier to permit. It's easier to install them, and it's extremely cost effective. So that's going to be the point of acceleration. What the numbers look like right now is at 35% EV penetration in 2030. We need about 30 million chargers. 28 plus million of them will be L2s. The rest will be DCs. Now, DC, which this company's installed a lot of and other companies I've worked for have done, it has a lot more complexity. But the majority of that charging is not going to take place on DCs.
Brendan, if you look at the distribution currently of EVs in America, it's places like Texas, California, where we're seeing a lot of the EV uptake. What we're not seeing is it uniformly across America, and you can really see that in the data in terms of the take-up the states have in terms of their utilizing of federal funding. Why are some states so slow? Why are local authorities being so slow to kind of roll this stuff out and take the money that is on offer? And how much of the money that the federal government is pushing into this space do you think has been utilized thus far?
So, there's no question when you talk about, publicly available chargers such as DC that in order to make the economic equation work, you need some public funding as that's the impetus. That gets it going, right? The smile states, as we call them, that's you come around California and go all the way up the East Coast, have always been the early adopters, and we're still seeing that manifest. Calendar year to date, California's at 22%. The rest of the nation is at 8%, which is a very, very positive sign thus far. Now, you're going to see adoption move from the West Coast to the East and the East Coast to the West, and that's what the data is bearing out. Now, the OEMs are bringing to market all sorts of different cars. So there's more pickup trucks that are EV than ever before, more SUVs. Right now, the OEMs have committed between 2023 and 2027 over $600 million in capital investment in EV platforms. And that money's been committed because they usually commit that 5 years in advance to meet the production numbers. So you're going to see this pickup happen. Now, where we're different from Europe, and we have operational entities in Europe, there's more of a mandate. There's more of some heavy tax incentives or heavy tax burdens when you buy internal combustion engine. The U.S. has decided to let technology lead the way, and we're seeing that in California. As just a couple of months ago, in a single month, California was at 25% EV penetration. As we know, the state mandate there is 100% by 2035, and you can't buy an internal combustion in that state or for other states. That's going to have this effect that adoption will push into the other states over time. From an OEM perspective, what you don't want to do is have to homologate or have two different kinds of state cars, ones that'll sell in California or ones that'll sell in Oklahoma. You want to get to you're selling the same kind of car everywhere. So we think economies of scale, the right type of policy and incentive dollars are going to drive that adoption across the country.
All right, really interesting stuff. Thank you so much for joining us, Brendan Jones of Blink Charging. We appreciate it. And we're going to have more on EVs in the next hour. We'll dive deeper with the CEO of Polestar, so make sure you're tuning in for that. But coming up first, we'll have today's Wall Street beat. The U.S. arm of China's banking giant ICBC was hit with a cyber attack that disrupted the trading of treasuries. We'll have those details next. This is Bloomberg. It's time now for Wall Street Beat, where we take a look at what is buzzing on Wall Street and the world of banking and finance. Today, we're looking at the hacking of one of the world's largest banks by assets, ICBC. Joining us now is Bloomberg's Sonali Basak. And Sonali, this was not just any hack. This is a hack that actually had major implications for the Treasury markets. How concerning is this? How big is the fallout?
Obviously very concerning. You saw the fallout in real time that regarded an auction that the market was already sensitive to. You saw buyers coming in more willfully at the front end of the curve. But when you start to draw out duration, you have a bigger problem here, just generally. So a hack that would impact such a critical part of the plumbing of not just the Treasury market, but new issue of Treasury here, you have a big problem, particularly for also a player in the market that is intimately involved in repurchase agreements. The repo market is a critical player when you think about the leverage provided to the system, and ICBC in the Treasury market over the last 5 or 6 years has become much larger.
Sonali, can you just talk about what's been going on over the last 24 hours? I'm reading stories of courier riders going around banks with thumb drives and plugging them into the USB ports of these banks to try and figure out how to settle some of this stuff. Is that the fix that we ultimately had to come up with?
It's the Band-Aid, the immediate Band-Aid. And, you know, the way I think about these electronic systems here, we've had a very fast electronification of the financial system over the last decade or two. And you now have a Treasury market where there's already, a ton of dispute on how trade should be cleared, whether it should be bilateral or centrally cleared in a larger way. And the SEC is in the process of really forcing the issue of central clearing. Now, let me give you an alternative view here. The idea here is that if you also have central clearing and that party, say the DTCC or somebody else, were to be victim to a cyber attack like this, then what would happen? And so I talked to Jay Clayton, for example, former SEC chair, just yesterday about this, and he's like, you know, I understand the value here of central clearing. However, there still is an issue here of whether counterparties are reduced so drastically to a small few.
Well, so Sonali, obviously a lot of these fixes might take a while to actually be put into place, right? We are talking about a process that might take some time. In the interim, what can be done to protect against this kind of thing?
Listen, you have a lot of banks and the most important parties, right? This is one major counterparty in the Treasury market here, but you do have a very disparate network as it stands today. The bigger issue is what comes ahead. Remember, the group that really had targeted ICBC in this instance was suspected to be Lockbit, which is a network of ransomware attackers here that have already targeted a lot of big firms, including a British fintech firm that was critical to derivatives infrastructure. Now, there's kind of, it's not good that they're being attacked, but at least we know it's kind of the same network of actors, I guess. But if you think about it, the broader problem and the wake-up call that really exists in this moment is, I think back to a conversation I had a long time ago with Scott Minerd when I asked him the biggest concern across the entire financial system that he would have is what would happen if the Fedwire were to get hacked. Really, banks and the Fed and a lot of major actors have really doubled down on cybersecurity, and we have seen some significant cybersecurity scares in the financial industry just this year. So it certainly is a time that people are doubling down once again.
Massive arms race underway, as you say, the hardening of these products, but It's a moving target. Shonali, thank you very much indeed. Shonali Basak on what's been happening with ICBC. Let's talk about what's happening with the markets right now. We're heading towards the end of the day, end of the week in Europe. I should probably flag something before we go. Shonali's going to be speaking to Citadel's CEO, Ken Griffin. This is something that I probably shouldn't have let go. It's quite important in this whole space, and we'll probably have some views on what's just been happening. So let's just talk about that. It's going to be happening at 1 p.m. Eastern Time, live on Bloomberg Television and Bloomberg Radio. OK, now we've done that, let's talk about where we are with the markets. Coming into the end of the day, coming into the end of the week, as I mentioned. Stock 600 certainly softening up today. Bunch of reasons for this. A, we're going into the weekend. B, obviously we've had a pushback from the Fed. That is something that you want to be aware of. UK data today kind of pointing towards stagflation. We're going to get CPI next week. Today you get the week growth. Next week, potentially, we'll see what we get on inflation. Brent crude, though, up by 1.21%. Maria Waitman, State Street, joining us next. This is Bloomberg.